Good morning, everyone, and welcome to the Real Estate Outlook 2022 that's hosted by Fine and Country. I just call on Mr. Demola now, just on the tax implications. A lot of people don't want their monies lost with taxes. After building all this wealth, then one tax man just comes to take it all out. But I think it would be very useful if you can just share a few highlights on what to expect, with some bit of focus on the Finance Act 2022. I know there used to be some concern around the grays, on whether or not there should be VAT on property, and then there was clarity provided at some point. So I yield the floor to you so that we can then take questions afterwards.
Okay, thank you very much, Isiri. Hi, my name is Goki Ademola, like Isiri had introduced. I work with KPMG as a manager. I'm not a real estate expert. I'll just start by issuing that disclaimer, considering the quality of speakers we've had before me. Quite a lot of them have given very insightful ideas and points on the real estate sector. However, what I will try to do over the next few minutes is to try to give us a tax perspective, particularly in view of recent legislative developments. The main one being the Finance Act of 2021, which was signed into law December last year and took effect from the 1st of this year, January 2022. And basically, I'll be looking at the implications of that act on the real estate sector and some other key tax conversations which we should bear in mind. So I'll just give a general idea. I have 20 minutes. I'll try to be very, very time conscious, and I'll try not to I have 15 minutes. I'll try not to take too long on any of the concepts. I'll try to make sure I speak to them as quickly as possible. But I'm just going to provide a general overview of what the Finance Act essentially was about or is about. So the Finance Act is a legislation, for the benefit of people who do not know, which seeks to amend tax laws on an annual basis. And so it's in a sense is an omnibus law without being an omnibus law, in the sense that it amends quite a series of tax legislation. The Finance Act for 2021 is the third of a series of Finance Acts. The first one, at least a third in a series of Finance Acts since 1999. This is the third one. The first one was in 2019. There was another one in 2020, and then we have this in 2021. This law amends 13 legislation, which you see on the right of my screen, from the Companies Income Tax Act to the Capital Gains Tax Act, up to stamp duties and some non-tax legislation as well. The key thematic areas for this law you'd see on the left of my screen. We're looking at domestic revenue mobilization, which is key for the government, as one of the, as we know, the government's or the budget for 2022 is, in a deficit of about 7 trillion, which means that a lot of activity or a lot of effort needs to go into raising financing. So this is one of the ways, in addition, obviously, to debt, which is a different conversation. Also, we have things around tax administration, international taxation, financial sector, and public financial management reforms. So what I've done here is I've just basically put a flash of some of what I think are key indices around the real estate sector. It is noted, for instance, that the manufacturing, trade, and real estate sectors have contributed 3.6% to Nigeria's nominal gross domestic product in Q3 of 2021. It's also noted that this sector grew by about 4.29%, and I think specifically the real estate sector grew by about 3.8% sometime last year, which in itself is a positive sign. It's a reflection of the direction that the real estate economy is going in spite of the state of the economy. We know that the economy has not fully recovered post-COVID. It's slowly recovering, but in the real estate sector, and I believe the luxury residential arm of that sector also continues to thrive for the same reason. We also have here the fact that interest rates are high, inflation is high, GDP is also declining. But what I want to do is just touch on some of the key reforms in the Finance Act of 2021. It's a very large legislation and it has a lot of provisions. So because we don't have time, I'll just try to focus on the ones which I think are material or maybe of interest to the group. The first change, which I will be discussing, is the introduction of capital gains tax on shares. And this is a very interesting change because historically, Nigeria has been one of very few countries that have failed to tax transactions of shares or transactions involving shares. What that meant is if you were an investor in equities in Nigeria, in the Nigerian financial markets or capital markets, you could sell, trade your shares with no tax cost. As a consequence, this created room for tax structuring such that a lot of high net worth individuals were able to acquire property by the use of corporate vehicles. What that meant is at the point of making a disposal, rather than selling the property in itself, you could simply dispose of the shares in the entity in question. And essentially what that would mean is you would essentially not have to pay any taxes in respect of that property. The title to the property still remains the same, essentially does not change. You don't have to go through the process of perfecting and things like that. And it proved to be an efficient mechanism for effecting some of these transactions. However, that has now changed. Going forward, if you are engaged in a transaction of shares and the value of that transaction is in excess of 100 million, you will have to pay CGT on that transaction. And depending for corporate entities, you'd imagine that will be 10% CGT on the profits, which is significantly more than the total 3% which is paid today. So that's something that a lot of real estate investors need to bear in mind from a tax perspective, how a change in the CGT framework would most likely affect them. Also, we have a clarification that was made in terms of REITs. Now, REITs is something that's been discussed on this forum, and it's actually very, very interesting. And it's something I had intended to speak on quite a lot during the course of my presentation. And I think the reason why I'm interested in REITs is because in 2019, when the emphasis on REITs, as a vehicle for collective investments was at the forefront. There was a lot of work which we did as some of the big four at KPMG, and we just basically helped to sort of understand real estate investments and also how the tax works. And essentially, there was a change which was proposed by the industry in 2019 to sort of ease real estate investments through REITs and effectively manage the tax exposure on those transactions. And those changes were put through in 2019. This year, further changes have now been made to, in a sense, clarify that a trust, which is a real estate investment trust, would also qualify for those friendly tax changes. We also have changes to the tax framework for unit trusts. Again, this also sort of ties in with what was done for REITs and the likes. In addition, there was a change to the Insurance Act. Again, this may not necessarily apply to directly to the real estate sector, but it's important because insurance is a critical part of real estate. A lot of these buildings are fundamentally insured, and so the state of the insurance sector is important to the real estate business. And so the change that has been made is to basically clarify what constitutes capital from an insurance perspective or for the purpose of insurance recapitalization. Also, there's been changes relating to, the digital economy. There's been changes relating to Naseni. Some of these changes I would not dwell on because they're probably of less consequence. Now, what are the opportunities that this creates? I think this is the part of the conversation where everyone is interested. Like I mentioned, in terms of shares or transactions for shares, it's very important that we start to recreate structures for divestment of real estate property. It also creates, it creates an avenue for revenue generation for the federal government as well. Another key point, which is very valuable, is the road infrastructure investment scheme, which was initiated via an executive order of the federal government or the president in 2019. And essentially what the road infrastructure development scheme entails is that it allows companies engage in construction of road projects with a view to clawing back whatever they invest in those road projects by way of tax credit, companies' income tax credit. Now the question probably comes to mind that what's the relevance of this? I think if you pay attention to a lot of developments in terms of private sector road construction under the scheme, you would realize that a lot of roads are being delivered more efficiently, quicker, which in a sense improves accessibility to some of these areas and also improves the value of real estate around a lot of areas. And now you see a lot of participants in the scheme, or a lot of corporates and corporate investors are beginning to declare interest in the scheme with the underlying objective of maximizing the value of their real estate portfolio. And so a lot of companies that have estates are beginning to declare their interest in the scheme. And it's a beautiful initiative because it lets a private sector investor participate in the construction of roads at ultimately no cost. So ultimately you will recover the cost of your spend under that scheme. We also have some of the economic impacts. We're looking at the impacts of interest rates on financing, which likely would mean that there's less financing available for investments in some of these large real estate projects. You'll also notice that there's a focus, or there's now a search for new asset classes because of the demographic. We have a young population that is primarily focused on tech. There's a lot of emphasis being placed on new asset classes like cryptos and NFTs and so the question probably then arises as to how the residential space can begin to leverage technology to develop or to basically improve on the sector. And finally, I think affordability challenges also then creates room for pooling of funds to basically invest in real estate activity through REITs. That also underscores the point which we were making earlier, which is the fact that REITs are a very, very important tool or vehicle to facilitate investment in real estate, particularly in times like this, where the economy is not, where it should be. And, there's a lot of people trying to diversify their portfolios and invest in multiple asset classes. And so we have less capital available to be deployed in some sectors, which then means that, pulling funds through these vehicles is a good idea. Also, one of the speakers mentioned earlier, they're very liquid. REITs like shares, they can be sold very quickly. They're very, very liquid, which also then improves their attractiveness compared to the typical real estate investments. So what you see is, there's a lot of growth in real estate investment activity around the world, especially in the face of the pandemic. We have a lot of the real estate players across the world recording significant growth in the prices of their stock. We also, in 2020, we recorded, the first REIT with, over 100 billion in market capitalization. And so essentially around the world, there's a general feeling, and the importance of REITs is emphasized. South Africa has made significant progress in this area. Ghana has also made quite a lot of progress in this area as well. And Nigeria seems to be struggling to catch up. And we have, like one of the speakers mentioned, the challenge seems to be the demand. We have few REITs, and a lot of people are potentially interested in REITs. So perhaps it's time to start thinking, of how we can invest in REITs and try to, create new REITs. From a tax perspective, like I mentioned earlier, there's a lot that's been done to improve the tax profile of REITs in Nigeria. So essentially, you as a REIT investor, you could potentially receive your payments, net of taxes, because REITs, real estate investment companies, are now, deemed to be passed through. So I think I've run out of time, but the general message which I wanted to emphasize is that there's a lot going on from a fiscal perspective to try to improve the outlook for real estate investors. So I will just, at this point, I will stop sharing my screen. I think it will be more effective if I was able to take a few more questions, targeted questions. Thank you very much.
Absolutely. Thank you so much, Ademola. And there will be questions. In fact, there are questions already streaming in, so we would push some questions your way, because you need to tell us more about this, your tax wahala. We don't want too many taxes, and we want the planning opportunities, absolutely. So I'd like to, and I like the point you raised as well about the road infrastructure tax credit, which is a very valid point that real estate developers also need to look into for the beautification of the estate or properties that we're building. That just brings in an additional credit as well. And not only do you get the tax credit for the project cost, but there's an uplift at MPR, which is currently about 10%, plus 1.25% or so. That's not taxable. And you can also trade the credit. So just a very valid point that Ademola made that needs to be taken advantage on. Give recommendations that I'm sure our listeners would thoroughly appreciate. Recommendations to investors and also intending property purchasers.
Thank you very much. I think a lot is happening from a tax perspective in terms of the fiscal landscape. And perhaps the first thing is to keep abreast of those changes, because some of them have material implications for us, especially over the next few years as well, because there are quite a few changes that will most likely come on board. I've mentioned some which are relevant today in terms of the transaction cost upon disposal of property, and the structures companies have typically adopted. So I think it's important for us to go back to the drawing board and have conversations that will help us recalibrate how those transactions are structured. Like I also mentioned on the real estate road infrastructure scheme, I think it's important that we begin to show some interest, or at least get some understanding of what that could mean for us. Some of those road projects have significant intrinsic benefits for our road for our real estate portfolio. So that's an area we should look at. And then finally, I think we all should continue to stay aware of developments in the real estate sector, especially from a tax perspective, and feel free to contact an advisor, like from a regulatory perspective and from a tax perspective, if you deemed so necessary. Okay, thank you very much for the opportunity. I think it's been a fantastic, very instructive session. I benefited more from, the guest or the panelists at the session, and I look to, attending more sessions of this nature. Thank you for also being a fantastic host and moderator, and the way you've sort of structured the conversation, excellent. So thanks to everyone on the panel. Fantastic being on the panel with you.
Thank you all so much for giving me this opportunity to moderate this session. It's really been a very fun time for me speaking to everyone here and just knowing about the trends for 2022 and what has happened in 2021. So I'd hand over to Mrs. Okonjo so she can give the last parting remarks, and then we will close the session together with lovely smiles. Great session.
Amazing. Thank you so much, Esiri. We can all agree that Esiri was just extraordinary. She was exceptional in the moderation, and she truly brought it all in. So please, a round of applause for Esiri Agbeyi, who's a partner at PwC. And, also massive kudos and thank you to all our speakers. Mrs. Omobola, thank you so much. Omotimirin, for bringing the regulatory perspective, absolutely critical, and for doing a brilliant job at that. Thank you. We're truly grateful and honored that you accepted our invitation to contribute to this conversation. Thank you, Mr. Ojo, for giving us such a brilliant, perspective on the luxury real estate. Mr. Akin Opatola, thank you so much. Every time we call, you answer. You're one of us. What can I say? Thank you. God bless you. Mr. Degoke Ademola, thank you so much for sharing, really in-depth insight from your perspective, regulatory, tax, REIT, all of that. Thank you so much. And of course, my colleagues at Fine and Country, I cannot leave you out. Ikenna Ajoku, thank you, well done. You guys are the absolute champions for making this happen. Onajite, who is our head of legal, Ikenna, our head of marketing, thank you for putting this together. Thank you to all our guests for staying through, more than 100 strong throughout. An incredible session. We're truly grateful. And please recognize that real estate is, as all our speakers have spoken, a very critical contributor to the GDP, to the economic prosperity of not just Lagos State, but to the nation. And so we should be responsible and learned investors. God bless you and see you on the other side.